Okay, so actually, yeah, 4 o'clock UK time on the dot. I'm quite impressed. We're back again now for the very final live panel session of the day, which is entitled Liquidity Maintaining Flows. And I did a bit like the collateral session last time. I find it hard to believe that this topic, liquidity, can be done in 40 minutes, but I have every faith that this panel is going to do this really nicely and actually be lively and entertaining and give us some real good up-to-date information on on the world of liquidity in securities finance and potentially beyond. So I'm not going to get in the way any further. I'm just going to introduce now our moderator for this session, Gabriella Fridiani, who's an independent advisor with ZBO International. So over to you, Gabriella, and I will be back in about 40 minutes. Thank you.
Kevin, thank you very much. You have not only made my day, you have made my week. And if I include Justin from SLT here next to me, you have actually made my year. I'm very flattered to actually be on this, or moderating this panel. I think the topic is of great value. If I had been in the position to choose myself 3 firms and 3 participants, definitely Guido, definitely Mike, and definitely David would be on board. They represent firms which have been very innovative, very intelligent, and I hope as successful as they deserve. I am going to use this 1 second to pass a little thought for one of us who passed away this summer, Joachim, who unfortunately is not with us any longer. And I will now introduce our 3 firms. I will start with Guido from HQLA, Guido Stromer. Guido, would you make a brief presentation for us for this session?
Sure. Good afternoon, everyone. My name is Guido Stromer. I am co-founder of HQLAX. Prior to starting this initiative, I spent over 18 years at UBS in various short-term funding and trading functions.
Thank you very much. David?
Hello, everyone. Thank you, Gab. Thank you for being part of the panel. I'm David Raka. I'm co-founder of WeMatch.live. And prior to that, I was working 20 years with BNP Paribas.
And Mike.
Hi, guys. Mike Norwood. I'm the product owner for the global trading product Equivalent. Before that, I had a background in agency lending for 12 years in operations, business technology, and product development.
Fantastic. So our topic is liquidity, and liquidity, as Kevin was saying, liquidity in securities lending is a topic which could take quite a long time to discuss, but this is the right angle. There are many drivers pushing the movement of the use of collateral upwards, whether it being pledged for margin calls, whether it be secured funding, whether it being seeking quality assets or HQLA. So I'm going to put the question first to Guido. We're talking about liquidity. Is that the right question?
Well, it's a very good question. The logo or the tagline that we're using for HQLX is to accelerate collateral mobility. And in fact, that could perhaps be a slight misnomer, because what we're doing at HQLX is improving the utility of assets without actually moving them. So we're actually maximizing collateral immobility by enabling market participants to fund assets out of, for example, hard to fund locations like Egypt, Egypt and Turkey, excuse me. We're also working with our clients to expand the types of assets that can be used in various securities finance transactions. So we're looking into expanding asset classes into things like money fund units, for which I think there's a significant demand in the market. And very importantly, we're also providing our clients with the ability to transact at very precise moments in time. So our start and end legs of transactions are not only defined by the start and end dates, but also by specific times during those days. And lastly, what we're also doing is expanding the time horizon during which ownership transfers can take place. So, market participants using our platform are actually able to transfer ownership for assets after markets have closed, or another way of saying it is after, for example, a local CSD potentially has closed. We still provide the functionality for clients to be able to transfer assets sitting in those locations even after the close. So I think that was a kind of a long-winded way of saying liquidity is important, but I think it's important also to judge the type of liquidity. So volume certainly begets volume, but it's very important to provide the market with different ways of raising liquidity or utilizing their existing asset classes or portfolio of securities that need to be mobilized.
I think we're going to come back on the theme of volumes, and as you said, we're in the business of transactions, electronic trading, and that's one of the questions come a bit later. But again, the word movement was put a little bit aside. The word use was definitely used, and then words like reach and timing and efficiency. And I'm sure, Mike, so you are on the other side of the pond. I know you're looking at the other screen because you're following what's going on with Trump. Keep us updated, please. The floor's yours now.
Yeah, thanks. And I'm on what Guido said. I mean, I think liquidity is certainly part of the answer, really. I mean, we're talking about liquidity here, but we're talking about a market where there's, somewhere in the neighborhood of $21 trillion in assets that are deemed lendable on any given day, right? So there's clearly a lot of asset available in the marketplace. But from a pure execution perspective, right, you start to talk about efficiency, right? So it's a matter of efficiently matching up demand and supply, efficiently executing trades, efficiently settling, right? And efficiently using these assets that you're able to locate, that you're able to source, and making sure that the entire chain of events from that initial inventory broadcast all the way through settlement and eventually the termination of the SBL trade happens in a manner that is efficient, that reduces cost, that adds scale, that makes it easy for the firms engaged in this business to transact.
We're going, I'm starting to see a theme here. So I'll come to you now, David. You set up We Match now 2 or 3 years ago. Your starting point was securities lending, but you've actually moved in a different direction. So is liquidity still the starting point for you in sec lending?
Oh, thank you, Gab. Well, I mean, in what we do and in the industry we work in, I think liquidity is key. I think nobody will deny this. And basically, I mean, the liquidity is one of the first and immediate and most obvious way to measure the efficiency of a market. You need to be able to, find an opposite interest, whatever you want to do in a market, with a fair level of price. And this is what is driving the pricing of an asset in any market. So liquidity is extremely important. Now you're right, Gabriel. I think since we've launched this initiative at We Match, I mean, the name of the company itself, We Match, means that there has to be liquidity somewhere. If I cannot match anything with nothing, right? So liquidity.
I always thought it was We Match.
So it's We Match. Yeah, We Match live. And this live dimension is extremely important because it's real time. So liquidity is key in what we do. Obviously, we need liquidity in order to operate. But where I think Guido and Mike made their point, which I agree with you, are a bit of a trend here, is that it's not only about liquidity. I mean, I think the angle and tackling the issue about liquidity through the vendor or provider angle is a very smart way, because I mean, we're not looking after liquidity, and we're not only looking after liquidity. I think what we're looking after is making sure that we have a service, we have an offer, we're looking at the workflow, we have it efficient, as Mike says, and I think this is where the name of the game is, because liquidity is inherent to our industry, to our market. We are not the ones building liquidity. I mean, liquidity is being built by our clients, by the users, by the dealers, by the banks, and by the lenders. I think our mission here is to make sure that we participate as much as we can to the completion or to the level of efficiency that this market is showing, and it's about a lot of things that I'm sure we're gonna discuss during this session. But this is the main point for me.
Okay, we're going to discuss this, and I'm going to come back to you because, again, you are the one who actually brought up the whole liquidity, and you are involved in other products, other services, TRS, swaps, and where effectively I can imagine that when you go with your offer, people say how much is on the platform, and by a rule of thumb, having been in the industry for some time, if you give any other answer than 77 zillion per day, you start explaining, I got a lot of offers, I got a lot of bids, a lot of people hooked up, I got blah, blah, blah. But I would counter argue that in this particular space, probably the measure of volume, I would argue, in fact, looking at the three solutions here, that you are not really creating as much liquidity as taking liquidity from one place and moving it somewhere else. Is that a fair point? And I'll start with you, David, on that one.
Yeah, well, I think you're right. I think measuring the success of our respective initiatives in how much we see going through the platform, the volumes, the trades, number of trades, or number of active and live interests we have on the platform is definitely important. But I'm going to use an expression I don't like too much, but it's in our case I think it's applicable. It's the chicken and egg thing. I mean, you need to start somewhere, and in order to get that liquidity or to get that flow, you need to. There's no other way than sitting down with the user and trying to understand where we can bring value. What can we do to bring value? And I think we are, one of the best testimony I've ever had since I've built and started to build the WeMatch is one trader in a bank who told me, with everything we've done together, I saved 3.5 hours a day in my day-to-day, and I can do something else. And this is the best victory you can have when you talk to a user and you offer a service, is to save time. And then by saving time, the guys can, or the girl can do something else, can bring value, and can focus on other things, especially when things are repeating themselves through our daily routine. So I think this is where we should all, and probably we do, have our focus, trying to really understand the workflow where we can bring value, and having this kind of product angle, which at the end of the day is going to bring liquidity, because there is liquidity in the stock lending industry, as Guido said to start with, and Mike, there is liquidity. There's plenty of liquidity out there. The question is, what do we do to increase the efficiency of the market and to make sure that this liquidity is used at its best and optimal way?
Or indeed create new relationships or new liquidity. And I'll turn to Mike. You mentioned $21,000 of assets. Is it thousands or millions?
Yeah, you understated that a little bit, but that's okay.
I seem to remember that the percentage of assets used in the lending process is in the single digit. And one could very easily argue that is the liquidity. If you want to include repo, you can add whatever. But
you're certainly looking at sub 10%.
Sub 10%. So is the name of the game in a firm such as yours, well established, coming from the equity side and moving, is the name of the game to say we will bring the liquidity up to 8%, 9%? Or is the name of the game, following up on what David has mentioned, to say I can make your liquidity more, save 3.5 hours, enable you to go outside. Well, that's not going to happen now. But you stay home or watch Netflix.
Yeah, I mean, I think David's right on. It is, how do you do the business that you're doing more efficiently, right? So, I think in success, you can talk about trade counts, you can talk about assets traded over the platform, you can throw out numbers in terms of maximum notional traded across the platform. You can even talk about market share in terms of trades executed or notional. But really what it comes down to is we know that demand is what demand is. We know what's executed in the marketplace, right? We see it from an Equilend perspective through our data lend product as well. So we know where we stand. But the question really becomes, how do we allow people to save time? How do we allow them to focus on the value add activities? And frankly, that is identifying sort of underutilized transactions in the automation space, things that people may not have invested in previously, whether it be bank to bank, whether it be in a fixed income space, whether it be sort of the hard to borrow space, and trying to work with our client base to bring the STP to those transactions that we may have done to the lower margin, higher volume trades historically.
Okay. Well, I'll finish on this topic with you, Guido. Guido, you quite scandalously mentioned that, no movement with HQLX. But if I look back at the drivers that we mentioned at the beginning of increased use or increased necessity of movement, which are the margin calls, the secured funding, and the sourcing of high quality assets, or the LCR. This is right down your alley.
Absolutely. So, our initial use case is focusing on enabling banks to fine tune their LCR ratios or LCRs more effectively. And that said, as we move forward in our product evolution, we're very keen to listen to our clients in terms of identifying pain points. To David's point before, he said it's all about creating value for clients and creating efficiencies. And how do you do that? You do that by listening to your clients and helping them identify specific pain points, and then you work with those clients to try to come up with solutions to deal with those pain points. I mean, it's not rocket science, but that's really the approach that that we're taking at HULX. And I've got a very specific example about this. I mentioned earlier about being able to transfer ownership for assets after the European market closes. So just last week, we had one of our clients approach us about exactly such a use case, whereby they have an internal use case to manage a large exposure, which in this case is not identified until after European trading hours. And this large exposure is actually one in between two legal entities of this company. And as a result of this company coming to us with this pain point, we are now going to be rolling out a specific use case to enable this client to deal with this large exposure after the market in Europe is closed. So this large exposure will then be managed in between 7 p.m. CET and midnight of the same day. And the beautiful thing about this particular example is, the banks that we're talking to mostly are the larger global institutions. That when one institution comes with a pain point and we're able to solve for a solution, it's very likely that there'll be buy-in from other institutions as well. And this is where, it's so much fun, quite frankly, to be in this space right now, because, there are so many challenges, there are so many pain points, and there are just so many opportunities to help clients deal with them.
So, and that's, once I'll pick up the last point you mentioned, which is once you have found a solution for a given customer or a binomial of two customers, and you've understood the chain and you've understood the efficiency, and you're capable of coming back to what David was saying, as that is my best selling point, then the next expectation, especially in models which are, I think, arguably linked, or from an economic perspective, linked to the amount of volume, then you find something that is replicable. I mean, one of the problems from me coming from repo, and repo is not a great example, was that electronic trading equates some form or shape of commoditization, start from the top and move down. And sec lending was always a bit of an exception. So the angle there is interesting. I'll come back to you again, Mike. So you come from you probably wear two hats. One which is where there is a very measurable liquidity which has grown over the years, and another part which is the land of exceptions. Would that be a correct way of looking at things? Would it be is it a fair comparison to say what you do in equities and what you do in fixed income is comparable?
I mean, I'd say that right now, we can look at fixed income and see that as an area of growth, right? And as we sort of heard on the previous panel in terms of demand for HQLA, that there is more in terms of on loan balances as well as inventory available on the platform in the fixed income space. I think in terms of our market share, in terms of how much we execute in terms of trade count, they're roughly equal, 63% for fixed income, 60% for equity. So we really do see them on par. However, we know that additional 40% is an opportunity, right? It's trades that are being done off platform. It's things that are being agreed via chat, via phone, via email. Those are inefficiencies, right? They're taking people time. There's time involved in locating the asset that you need. There's time involved in negotiating the terms of the deal that you're looking to put in place. And then certainly when you look at the regulatory impact, if you talk about SFTR, if you talk about reporting, all of the manual entry that goes into processing those trades in an off-platform manner create an opportunity for break. Right. So, if we look across our platform, we certainly could see that if it's executed via an electronic trading platform, we have a break rate once it hits our post-trade reconciliation tool of sub 1%. For everything else, it's in the neighborhood of 25 to 30%. Right. So all of that 25 to 30% is additional noise, it's additional cost, it's additional overhead that gets baked into the overall platform and reduces the efficiency of the trade. So, for me and for my team, certainly in terms of reaching out to clients and working with them to try to identify solutions, the first place is to identify those gaps, those underserved areas, the areas that have not taken advantage of the tools that are in place, and try to work with them to make sure that our offering allows for those products to come online, for those trades to come online, and for the additional liquidity from those asset types to be introduced into the platform.
I can see, David, that you're nodding. I mean, you obviously in your past life, as you once mentioned to me, you had the advantage not given to everybody to be able to change hats because you're responsible for a whole range, in fact, the whole range of products. Yet you started with securities lending, and I can see you agreeing with Mike on these particular points.
Totally. I think, well, obviously, Guido, Mike, and ourselves, I mean, we obviously have a lot in common in what we do. And I think what I've been learning a lot over the last 3 years is that, well, it's a tough game, obviously, to digitalize and to get a challenge of digitizing a market which is extremely bespoke, which is very, looking after chats, relationships. And the really interesting part, and where I've been learning a lot, is that actually we are on a journey which goes from onboarding to adoption, and then the ultimate goal is to go into addiction. And the way to approach that is that looking after the onboarding is really like a very, I would say, a top-down exercise to address all the risks that banks, dealers, custodians, lenders have today. Well, execution risks, P&L risk, because I mean, execution can be extremely expensive, operational risk, conduct and compliance risks when the traders are starting to chat over Bloomberg or wherever you can feel. And addressing those risks one by one and explaining why the platform and going into more of a digital solution kind of addresses those risks and answers those risks and even tries or gets to neutralizing those risks in some instances, then you get onboarding done. And I think as far as we're concerned at WeMatch, this is where, I mean, this is done. This has been done now with most of the players in the industry. Adoption is the second pillar. And adoption is where you start moving away from the top down, starting to go a little bit more into bottom up and trying to really sit down with the users, sit down with the traders, trying to understand their workflow. And to come back to what Mike was describing, is trying to get, to that little piece of the workflow where you realize the trader is losing a lot of time, or is not protected in what he's doing, or he's taking a conduct risk that maybe he wants to neutralize because, when you have a compliance officer coming 3 months later and asking why you've traded at that level, well, maybe you just want to say, well, it's been done on the platform, so everything is kind of logged, and I can ask the provider to provide you directly with the logs, which explain why I've traded that level. And then once you've done adoption, this is where it's the fun part. The fun part is when you get a trader who is already kind of adopted and who uses the platform to kind of turn him or her into addiction, to say, okay, the first thing you need to do when you come in the morning is to open your desktop and you open your application, so Equiland or WeMatch or HQLAX, in order to make sure that it is completely embedded in your day-to-day activity and in your workflow. And that's, I think, the challenge we all have, probably, at different levels, obviously, of maturity, but it's extremely exciting. And the whole, I would say, liquidity matter or liquidity issue is obviously inherent in anything we do. And the more we go into the journey, the more we get liquidity, and the more we have an efficient liquidity, which is kind of going through the workflow and through the platform.
I can see you all agreeing on this point. I would add, coming from other industries, that once you've done all that work, you should expect replication, duplication, other solutions, a very, very tough learning curve. As you mentioned, all three of you, it's not just someone sends an idea. This isn't the kingdom of ideas. But we are also in a space which, once those solutions are found, is extremely sticky. Is that a fair comment? And I mean, David, obviously you deal in swaps. It's pretty competitive. Equilend has a number of competitors on the HQLA side of things. HQLX, sorry, I always forget the X, and I don't want to mention it too often, but it has other connotations somewhere else. But you obviously what you don't want is to do all that hard work, all that iceberg work, which is finding those details and testing them and making sure there's a result, to not end up with some formal shape of reward. And isn't the reward the stickiness? I mean, do you lose customers to competition in that sense?
No, I mean, as far as we're concerned, I think we're very happy to see that, and this is one of the metric that we're looking at, is how regularly users are coming back, and we're very happy to see that they do come back. I mean, when the users start using the platform, usually they stay and they don't go away. And we have a way of working as well, as you say, which is to systematically try to leverage what we're doing, maybe in one product, in one asset class, in one sub product. To try and make sure that what we do can benefit the rest of the asset classes, even though, I mean, all markets are different. There's still like protocols, like features to protect, the traders from market movements. I mean, whatever. I mean, we systematically try to think in how anything we do in one product or one asset class can benefit the others. And the last example we had, obviously, which is the most obvious, is we've, as you say, I mean, we've developed what is today, what we hope is seen as a very strong TRS platform in EMEA, and very happy to confirm and share with you that actually we've launched in the US last month. And obviously we managed to kind of really leverage not only on the product, but on the stickiness of our relationship with our existing users in Europe to roll out the platform in the US. And this is working extremely well. So it's all about, exactly as you say, it's a very different way of approaching things. And stickiness is, I agree, very, very important.
And liquidity is part of that stickiness, right? So if there's not enough liquidity on the platform, you're not going to be sticky. If people see that their orders are going unfilled, that they're not having the match rate that they're expecting to have, that they're not getting the execution that they're looking for, then that's when you open yourself up to competition. That's when you open yourself up to someone else coming in and users looking around for different solutions. So it is, to bring it back to the theme of the session, I guess, that liquidity does become vital in terms of making sure that your platform is sustainable.
Yeah, I think it kind of goes back to what David said earlier. It's the chicken and the egg, and then, self-fulfilling prophecy around liquidity begetting liquidity. There's no question about that. David, you are my hero, though, in terms of onboarding, market adoption, and addiction. I'm definitely going to keep that in mind. And speaking towards the onboarding, and it's quite difficult in the very beginning to go through the onboarding process with the initial clients when you're bringing something new to the market, particularly when you're dealing with highly regulated institutions. And I think one important point to remind ourselves of is that in getting this market adoption, and perhaps David, you can elaborate on this thing, it's really important for the onboarding process to be as easy as possible, because banks are obviously very limited in the resources that they have to connect to platforms. So that onboarding process itself needs to be one that is relatively painless. And some lessons learned from the HQLX side in terms of, again, listening to potential new clients. So we're currently engaging with the agent lending community as a source of LCR capacity, or of upgrade transactions. And in so doing, we've received feedback that many of the agent lenders actually execute their lending transactions either on a direct basis or actually through institutions like Equilend and possibly WeMatch. So, from the HQLX perspective, we definitely listen to that kind of feedback, and we're definitely open to collaborating across the industry to fit the needs of our clients. And when we hear clients say that, well, we like your platform, but we'd love to execute these transactions by institution X, Y, and Z, we are quite flexible in, listening to that feedback and working for solutions to provide connectivity with those companies.
And I think that's the challenge from the vendor perspective, right? Is how do you make it as easy for a client to use your solution as possible, right? From Equivalent's perspective, from an NGT trading perspective, we had a journey of our own from sort of the old GC auto borrow schedules through what NGT is today in effort to sort of unlock additional trade types and additional inventory, additional liquidity in the marketplace, in the non-GC space in particular, right? And to create efficiency in that area. And we know that we've had some challenges just in terms of adoption of some of the technology standards that are out there, getting universal builds of all of the functionality that's available, right? I certainly know that our trades are relatively efficient, provided that they're in response to either, an indication of interest or in response to sort of a broadcast availability, but we still have thousands upon thousands of unsolicited bids flowing in every day at a hit rate of around 4%, right? Where we know if you build the full infrastructure, your hit rate's going to be 30 to 40%, but getting the clients to come along, getting them to invest the resources becomes a point that you really have to try to demonstrate to get them to allocate their limited tech resources to enhance a process that's already working.
And then just to make this easier, start dealing with the buy side in terms of capacity. One of the so actually we've got a couple of minutes left, I think, and I haven't seen Kevin reappear. So in terms of obstacles, we've actually put your finger on the obstacle, which if you sort out actually becomes the stickiness, which is the efficiency, and that obviously is an investment on both sides. In the panel, in the discussion, we had a number of one point that was brought up, asking whether you gentlemen representing platforms or representing venues or representing marketplaces were constantly improving, which obviously you have to, if not you wouldn't be around, in order to meet the new challenges, including the looming CSDR. I'm not a completely neutral on that one, in the sense that I don't see how that has any bearing on liquidity. But as a rule of thumb, and we take CSDR because that's the latest one, isn't regulation or change of regulation sometimes a plus for an electronic platform rather than a negative? And I'll start with you, Mike, on that one.
Sure. I mean, I certainly think it's an opportunity for us as technology providers, right? I think the regulation, the theme of regulation in terms of efficiency and settlement, if you look at CSDR, in terms of efficiency of reporting and how closely your books match your counterparts in terms of SFTR, right, means that everything has to be done cleanly, right? Where in the past we may have been able to overlook certain, non-priority breaks in our contracts. We don't have that luxury anymore. Things have to be regulated. There's potential penalties involved. Things have to be done accurately, efficiently, and in a timely manner. And the only way to do that, given the volume of transactions that's in the marketplace, is to use a technology provider, right? We have to be able to accurately book both sides of the ticket. We have to be able to accurately settle. And the only way we're going to get to matching is electronically, right? If you're doing it all by manual rekey, you're going to end up with some error rate baked into that process, and it's not going to be acceptable going forward.
For you, David, opportunity?
Definitely. I mean, I've always considered that actually we are as providers, we are fully aligned with what the regulators are doing at the moment on the SEC financing industry. I mean, one of the main concerns of the regulators and what they've been fighting for is to really fight against opacity and go into more efficiency through reporting, through transparency. And we have the same fight. I mean, obviously, bottom line, I mean, we are fully aligned with those concepts, which is why, by the way, I think it's interesting on SEC financing to look at the liquidity angle through the platform, through the platforms one, because I mean, we are fighting for better efficiency and in the end, better liquidity on the SEC financing market, which could be very different if you look at the same angle for other asset classes. And as you said, Gabriele, I mean, we have developed similar platforms on equity derivatives, on Delta One, on interest rates, and when if you look at Delta One is all about it's all about the workflow. There is something called an exchange where you have liquidity, where you're able to kind of buy or sell a future extremely easily on a GUI which is provided by Eurex, why would you go on a platform? It's all about the workflow and how we can plug into the client's workflow through an API or through a specific one in order to make sure that we bring value to the whole workflow. So sec financing is a very, very interesting spot.
Guido, this must be music to your ears.
Yeah, that's a layup for me. Thank you very much, Gabriella. So, regulation essentially was the key driver for the development of HQLAX. So, just to summarize again, our initial use case is to enable banks to execute upgrade and downgrade transactions more capital efficiently by saving on intraday credit exposures and also intraday liquidity requirements. And as we build out the platform, we are starting to uncover some other potential benefits that the market can achieve by using our platform. So the initial use case is around banks and capital cost savings for banks. But as we engage with the agent lending community, as I mentioned before, we're now in the process of trying to identify the benefits to an agent lender executing a delivery versus delivery transaction on our platform with a bank borrower. And in terms of those benefits, broadly speaking, one benefit is to do more business, to get more loans out as a result of the banks executing with the agent lender, are motivated through the capital cost savings they're achieving to do more business with that agent lender. But then there are also some other potential benefits that we're trying to now kind of validate with the community. One relates to the ability for a beneficial owner in an agency lending program to reuse the digital collateral record that they receive, possibly to pledge, for a UMR obligation. And then also, as a result of our collateral immobility, the implied benefit there then is a reduction and or possibly an elimination of fails risk. Since the securities in our operating model never leave the location of the collateral giver, there's significantly lower fails risk to a beneficial owner in terms of, upon a recall, not being able to get their securities back. So therein potentially lies a capital cost savings for the agent lender's indemnification cost around CSDR and buy-in risk for their beneficial owners. So in all of our product development, I would say, is in some shape or form related to to enabling the banks that have onboarded and the future buy-side clients that will be onboarding either directly or indirectly to deal with the pain points around managing regulations, whether that's LCR, CSDR, or UMR, actually.
Gentlemen, we have 1 minute and 30 seconds. So I have a number of questions coming from the audience. A lot of them are regarding where did you get your jumper, Guido? So I'll ignore those. Another one, they're asking me about David's personal phone number, Miranda. I will close the session now. We've talked about liquidity, but what we've really talked about is quality liquidity. We've talked about efficiency. We've had the usual chicken and egg, chicken and egg, chicken and egg. Let me see what happens. We've had, which in reality is probably the wrong approach. I hope some of your future customers or potential new users, you mentioned the buy side, you mentioned new areas. Mike, you mentioned new underlying assets. Will take in mind that there's an investment both ways, and that we come out of this thinking that liquidity is key. It's probably a consequence of what you do rather than a starting point. But in this particular space, I would view liquidity and any looming or blooming, whatever the word was, in other segments or in other businesses have actually been, and particularly in the case for Guido, real opportunities to look at how to make these markets more efficient, grow, create new pools of liquidity, and make everybody happy, including me. And I think,
that's the most important part, Gabrielle, keeping you happy. but you're generally quite happy, so it's an easy challenge to overcome.
Kevin, where do I put it?
Excellent. Now, this is what I mean by liquidity, Gabriella. Excellent. So I just...
Kevin says, don't touch it.
And well done for wrapping up on time. It's an excellent job, by the way. And I really enjoyed that. I also had some laptop glitches through that one as well, so I missed a little bit of it, but it's timely that I can remind everybody that you will be able to see all of these sessions. They're recorded, so you can use the platform to watch these again at your own time. And I'll certainly be watching this one in full just to make sure I catch everything. So thanks to Gabriella and thanks to the rest of the panel. Now, my job now is just to wrap up and then pass over to Justin to say a few words, just to finish the day off. Just a few seconds of personal observations. Clearly, it's very pleasing to me to hear throughout the day that ISLA and other trade associations continue to play a pretty important role in the development of this market and helping to support the market. A lot has been developed in this marketplace since I was last involved. And lots of initiatives in place to both drive efficiency, drive down costs, meet the demands of regulators, and drive revenues. And so that's all very, very pleasing. For those of you who were with us for the very first session, you'll understand what I mean when I say that the organizers have also told me that they plan to employ Nick Bruce's dog as a timekeeper for future panel sessions. For those of you who weren't here, Nick Bruce's dog started to bark just around the time that they were due to finish. So he did a more effective job than I did. And I think that's about it. So just before I pass over to Justin and then go revisit the fridge where I put my wine in earlier, which will be nicely chilled by now, I just want to say thank you to our speakers today. Thank you to everybody who's joined us, particularly if you've been with us all day. It's been great. And maybe I may see you again in another 4 years' time. And who knows what? Maybe we'll be welcoming a new president, Kanye West, or someone like that. Who knows? Anyway, on that note, thank you very much. And I think we're going to pass over to Justin now with technology. So I'll leave it in the hands of the folks who are controlling the technology to make that happen. So thank you.
Ladies and gentlemen, virtual delegates, my name is Justin Lawson. I'm the co-founder and managing director here at Black Knight Media. Many of you have seen me at one conference or another around the world over the past 10 years of publishing Securities Lending Times, just probably not the past 8 to 9 months. I have a few words to say, and then I've got a small announcement to round off the day, which I know many of you are looking forward to hearing. Firstly, I'd like to thank Market Access, our platinum sponsor, and all of our other sponsors for the support shown with converting this event from a physical event, which we had planned earlier in the year in May, into a digital event, our first ever foray into digital event space. Hopefully you'll all agree it has been a huge success with some excellent panels and great networking opportunities. Secondly, I'd like to thank Kevin McNulty for comparing the day, all of the moderators who did a fantastic job, and Michaela and Gossier of Event Rock for all of their organisational work that went on behind the scenes. Securities Lending Times has been running for over 10 years now, and we feel that now is the time to rename the publication and launch a new website. The change is only the slightest of changes, but we feel it allows our audience to understand the greater coverage that we as a publication offer. Moving forwards, the name will be Securities Finance Times. Please feel free to go and check out the new website launched earlier today, securitiesfinancetimes.com, and let us know your thoughts on how the website looks, what you think of the name, or anything that you would like to see us incorporate moving forwards. Many thanks again, once again, for all of your support throughout this year, the past 10 years, and moving forwards into 2021. Thank you.